So welcome to episode 5, guys, of the 100 Days in Finance Investors Lens with Lusimadio. Lusimadio is our speaker. We've been with him through the first 4 episodes. This is now episode 5. Unit Economics, Unlocking Profitability Blueprint for Investments. If you're an investor, what are the key things that you actually look at when you want to invest in a company, whether it's growth, profitable growth, break even, or your scalability? Lusimadio is here to actually demystify all those things. Man, too much sec, going on. Thank you so much, Lusimadio, for your time. Thank you so much for coming through for us. I think on the last episode, we learned so much about stocks and bonds and equity and shares that today we can't actually wait to learn something more. So thank you so much for your time.
You're welcome. All good.
Yeah. So I think we're just going to get right to it. In building a blueprint for profitable investment, there are 2 terms I'm actually looking at. One is growth, and the other one is profitable growth. Maybe you can demystify for us what's the difference between growth and profitable growth when looking towards investing towards a business or a company or even a stock or a bond. Yeah.
There is this myth, right? Oh, no, I'm not gonna call it a myth, but there's this reality of big companies, big organizations like your Amazon, that they ran Amazon for years, but Amazon was never recorded as a profitable company, even though it was growing so fast, right? There is this idea there that many people don't understand, and I really want people who are following me, either you're an investor or you are an entrepreneur, to have this clear, because there's a difference between a company coming and tell you that, oh, we are not profitable, but the company is running, the company is growing, but then they say we are not profitable, right? And there is also that idea of actually not being profitable at all, right? And the company is apparently knowing a certain level of growth, earning so much market, but there's no money, right? I want you guys to understand these 2 different things and must be very clear. I don't want confusion on that. There's a difference between a company that makes money, but they reinvest their profits into the business, right? And there is a company that actually doesn't make profit at all. Like everything that they make, it's just negative, right? They see so much that they're making in the revenue, but when it comes to subtracting the profits from the revenue and the sales and everything, it just doesn't make sense. That the math doesn't match. Okay, so here it's something that I want all of you to understand, is that there is no positive growth without profitability. Okay, every time a company has its chart moving up, it has to be directly proportional to its profit. Okay, there is no way. Yes, someone will come to me and say, no, but there are companies that are growing, but they're not making money. Yeah, you need to understand, why are they not making money? That's the question. Why? Okay, because companies like Amazon, they will tell you that we have spent years of growing the company but not making money. Why? Because they were making money. However, the money was reinvested into the business so it can continue to boost the company until they can be in a level where they are able to now take the profit home. You get what I'm saying? So this is what sometimes a lot of entrepreneurs and investors don't understand. So you can't be compared to a company that moves its finance strategically with a company that actually don't really make money. Okay, so the idea of growing but not making money, it usually comes down to that perception of how are you using the money that you make, number one, and number two, what is the margin that you actually have to gain. The margin is important. Sometimes the idea of you not making money is the margin. So you're selling a lot, but the margins are very low. So you have to look into it. If your product is, if you sell a product that costs you $10, for example, but then if the product to get to the market costs you $10 and your margin is $5, right? You are basically selling the product for $15, but you make it $10, then your margin or your profit is $5. That is half of what you spend for the product. So how do you expect to make money in that condition? Because for you to make one product, you have to sell two products. It doesn't make sense. So in that case, you don't make money, but you are getting a lot of orders. There's a lot of people asking for the product, and it's going, but you don't making money. So that's the case. And now it's different with a company, and I will repeat this, is it different with a company that has high margins, they are making money, the revenue is growing, the company is growing, but they're using that money and reinvesting back to the company so that it can be able to boost the company to higher levels, and then they will be on the time, they will be in a level where they can be able to like take the profit home, cut their own cake, and be happy. That's what is happening with Amazon now. For a very long time, they were reinvesting their profits in the company, and then now they can be, Jeff Bezos can go home with a big check, because it was a strategy in the beginning.
Let me start. Like profitable growth, a good thing, as opposed to growth, like growth of a company. Let's say, okay, let me just put it like this. The way you've described it, some companies, yes, they may not be posting profits. Let me just do this. Yes, they may not be, posting profits, but they have reinvested all their money into regrowth of the company, as opposed to posting profits. So you find a company like that will outlast a company that's constantly just posting profits. Oh, okay.
I mean, differently. I mean, you look into the thing. The perspective here is that your margins must be higher than the amount that you spend to produce the product. Right? Always go for an equal level margin or a higher margin. So if your margins are exactly the same as the amount that you are actually spending to create the product or to get the product to the market, if it's the same level, that's when we talk about break even strategy thinking. So the break even basically means that you need to make sure your company expenses or your company operational costs are equal to your profits. Okay, that's the only time you can be able to break even. Okay, operational costs,
expenses are equal to
your profits.
Operational costs are equal to the profit. Equal or the profits are higher. The profits are higher than operational costs. Okay.
I mean, the break even idea means simply that your profits are equal to your operational cost. That's basically the break even idea.
Actually, you've even gone to now the second question I wanted to ask. Breaking even for somebody who has no idea, they want to go in as an investor. who doesn't know about breaking even. How is breaking even evaluation done? What is breaking even, first of all, and how is breaking even done? Evaluating breaking even of a company before investing. Yeah.
I mean, you need to understand something. This idea of break even and the calculations are very technical. So you need to calculate basically how many products you need to sell in order for you to be able to break even, right? So now the break even mindset means your expenses and your profits must match. Okay, that's the break even idea. So this is very much for entrepreneurs who are starting and they need to break even, in a point where basically when you break even, you don't make a loss and you don't make a profit. It's all zero. It's like a 0 point.
Yeah.
Correct.
Oh, okay. Yeah.
Because remember, when you start a company, when you start a business, right, you're on a negative because you are the one you're spending, right? You're on the negative.
Yeah.
So you start negative, -5, -4, -3, -2, -1, and then you get to 0. Okay. So now, when you get to 0, that's where we call break even. So on a break even, you don't make profit, you don't make loss. It's 0 for both on both sides. Okay.
Yeah.
So now there are technical calculations differently on the background that needs to be done via Excel and other things for you to understand how much do you need to sell or how many services you need to provide or how many products you need to sell in order for you to break even. So those are the points, right? I will give an example, very practical when it comes to break even. Let's say, for example, you are in the products market and you are selling shea butter, for example. I know shea butter is very popular in Kenya, right? Let's say shea butter. So you have a shea butter and you're selling the shea butter on those small containers of 20 milliliters, right? So you have that, and you know that your production for that one 200 milliliters shea butter container or product, cosmetic, you have to pay at least $5 to get that done. Okay. So that means that includes your whole process from the manufacturing to packaging to getting the item to the market. $5. Okay. So now, if that is a $5, right? Now, when now you put your costs of your production for $5, then you put your labor cost, your transport cost, your electricity cost, your water cost. Maybe you have maybe 2 employees cost, your payroll. Okay, so when you join all these operational costs together, your marketing costs, your whatever, you put them all together, it will cost you, maybe, let's say, for example, $1,000 USD, $1,000. Okay. So with the $1,000, that is your operational cost. Everything needs to be done in a month. This is how much you spend for you to get your stuff done. Okay. So $1,000 for you to get your stuff done. Now the question is, for you as an entrepreneur to break even, right? It means that your breaking even point means that your operational cost, which is $1,000, should be equivalent to the amount of profit that you're going to make. That means you need to also make a profit of $1,000 for you to say that I break even. Am I making sense?
Definitely.
So you need to make a profit of $1,000 for you to say that you have broken even, because your profit of $1,000 it's equal to your expenses of $1,000. Boom. Once they meet, it means you are on a break-even point.
And is there like a time frame for break even to happen so that like you can go to the next level? Because it can't just be
no, there's not specific. There's no specific time frame. You put the time frame. It's part of your marketing efforts. You put your time frame, and you say that in the next 2 weeks I need to break even. It's your effort, because you're going to have to put effort on the sales, on marketing, on engaging with people, and how much you're going to have to put. Like, that's it. That's just what it is. You don't really predict and say that in the next 5 years I'm going to break even. You can break even anytime. You can break even in the next 2 days. So the market is very unpredictable. There are things that can happen at any time. But your objective as an entrepreneur is to understand that how do you calculate your break even. So understand that your break even point is when you are on a zero profit and zero loss. That's your break even point. So your profit and your expenses are the same, equal, boom. Okay, that's what it is. Then when you start making more profit than your than your operational expenses, that's when you now can say, I'm making profit. I'm profitable. That's now when you say I'm profitable.
Yeah.
When your profits are above your expenses. That's when you say I'm profitable, right? So now, you now need to, and the process is the same. Like the same idea of break even, the same thing is the same idea of when you want to make more profit. Just calculate how much you need to sell in order, or how many you need to sell in order for you to make more profit than your expenses. That's all. If for you to break even, you need to sell, $1,000 of products. For you now to make more profits, or to make profits above your expenses, you need to spend, you need to make at least, 1,500 of product sales. That's it. Now you can say that I make 500 profit every time I sell, and the profit is always growing. It's always growing. But now, related to how big the company becomes or how the company grows, we all know the life cycle of a business. You understand? So you're starting your business, it's still an immature level, it's still a baby, it's still a small business, small company, and you're growing, and you only know how big your company becomes based on two things. Number one, your liquidity level. Number two, your cash flow level. And number three, you look into how your expansion level, right? So if your company is expanding to other horizons, to other places, other communities, other cultural, geographic places, there's an expansion growth, which also comes with all its own expenses. But you look into that. Number one, that location growth.
You've actually gone into now the next part, which is now the expansion. The expansion, like let's say, scalability of a company. Yeah, the ability of the company. Actually, there are two things you've actually touched on. One, costing of the product. Yeah. How important is the pricing system when you're looking at investing into a company? How important is the pricing system, and what maybe you can describe in simple terms what a good pricing system usually entails. And then number two, what makes a business truly scalable from an investor's perspective? What are some of the things you actually look at that makes a business truly scalable in such a way that you'd want to actually invest in it? Yeah. Okay. Yeah.
Okay.
Maybe
to respond to. Yeah. I think there are a few factors, right? There are a few factors.
Mm-hmm.
But I'm going to be very specific on which is the most important factor when it comes to scalability. Your pricing doesn't really necessarily speaks up to your ability to scale, because it all comes down to how you use your own funds, how you're using your profits, right? So scalability comes, it's a strategy, and sometimes it involves a proper allocation of funds. And as an investor, let's say from an eye of an investor, when you reach out to a company or to a project that you feel like you would like to invest in, yes, and analyzing the ability of the company to scale or the product to scale, it's crucial. So you want to invest into something that appears scalable, okay? Appears scalable. There's a saying that in the environment that people sometimes say that there are businesses that cannot be scaled, right? There are businesses that cannot be scaled, or there are products that cannot be scaled. I always say it's false, because it's either you don't understand the actual environment of the actual business, right? Or you just don't want to put up the work, right? So every single business, no matter where you are operating, no matter what you're doing, or what type of projects you are into, what environment is it around your business, every single project or business is scalable. Every single idea for business purpose is scalable, as long as there is a proper understanding of the environment and there is a great financial literacy. Now, pricing can be a factor to dictate a company's ability to scale. How? You look into the margin, okay? When you price an item, your margin, as I said in the beginning, needs to be as good as your ability to grow it, okay?
Yeah.
That's number one. Your margin is important. How high is your margin? And sometimes from an investor perspective, I can just ask your product, I can ask you how much you're selling your product and how much you produce it, and look at the margin, and I can tell you if you're going to be able to make money or not, or if you're going to be able to scale it or not. And I can also tell you if you'll be able to pay my money back or not, right? So just by looking at the margin in your pricings, right? Number two, your ability as well, you also are able to see scalability of a company when you look into the type of people who are working in that company, right? Sometimes if you are an entrepreneur and you're running a company but you're not a full-time entrepreneur, it's hard for an investor to invest. Why? Because an investor wants to invest in a company which the owner and the founder is 100% invested in it, right? If you are not 100% invested in the company, there's no way for you to see, for me as an investor, to see that there is a possibility to scale this company with no 100% commitment, right? That is why it's hard for investors to invest in companies where the entrepreneur is on part-time. Yeah.
As an entrepreneur, or as a founder, or as a business person, you have to be 100% invested in the goal for an investor to actually come and invest.
Yeah.
For them to actually even think of whether you're going to scale or not.
Yes, 100%. 100%. It's not just about how much money you're making as a profit from your margins.
Yeah.
It's also about how invested are you in the company. You know?
Yeah.
Hardly, let me tell you, hardly you're gonna find an investor who is going to invest in a company led by a young boy who is still in school. It's never gonna happen. Okay? Because it doesn't see the possibility of that company to survive.
Well, but see, I think, like, isn't that some sort of bias? So, like, now, what if the company is actually bringing back revenue, or the product is actually revolutionary? So the investor won't see any value in that, as opposed to, I don't know. Well, why would it?
No, look at this. Look at the picture, right? Look at the picture. how much money do you think a worker will generate by working part-time, and how much money the same worker will generate by working full-time?
Okay.
Simple.
That actually makes, that actually makes sense.
So it's the same, in the same idea in the mind of an investor. I'm giving you my money, but you're not full-time in the job. What do you think is going to bring my money back?
Yeah, that's true.
Right? So
yeah,
you as an entrepreneur, you've got to show that you are 100% committed to the company. 100%.
Yeah.
Then you can look into the facts of the financial issue when it comes to pricing your product properly, so that you can be able to have good margins, for example. You see what I'm saying? So that is the idea.
Yeah.
We look first of how committed you are. Are you full-time on this thing? Yes. That is why sometimes when you say in entrepreneurship, you can't be doing a 9 to 5 and run a company and be an entrepreneur at the same time. It's not going to work. Because you're going to end up having to decide to leave one to follow the other. Okay? Yeah. So you as an entrepreneur need to have that in mind. If you're going to pitch your company to someone, you need to show commitment. You need to be the person saying that, look, I'm ready to scale this company because number one, I'm committed to it 100%. Right? Then number two, you say that my company I'm ready to scale my company because my products is selling and I'm making profit, you know, and then they will look into the margin. Yeah, no matter how good your numbers are, but if you're not committed to the company 100% full time, they're not going to invest. Because who are we investing into? Who's going to run the company? You are not there, right? Yeah. So that is the problem that we have. Those are the two major issues that we have when it comes to scalability of companies, and that is what goes into the mind of the investors. Okay, because I do have a book, by the way, and I will take that this time. People should go on Amazon and buy the book I wrote. It's there on Kindle, KDP or KPD something on Amazon KDP, Kindle Publishers. So you will find it there. It's called Entrepreneur's Handbook. The guide, it's the guide for the business growth in Africa. So it's a practical guide for business growth in Africa. You just go check it there. Entrepreneur's Handbook, practical guide for business growth in Africa. I also explain the difference between what your customer thinks about your product, what you think about your product, what investors think about your product. And what also your partners think about your product, because you have partners, you have investors, you have customers. These are three different categories of people who perceive your product differently. So when you approach them, there's also a different way you approach them. And on that book, I did highlight very carefully and detailed how to approach investors and what is in the mind of investors when you are pitching to them about your company or your product. So I will advise you guys all that are following to go and look for this book on Amazon. It's there for I think $10. Find it. You will get so much value into it, and it's you will have the e-copy that is there available. The ebook is available there. So you must understand that the investor's idea is always on, am I going to get my money back? That's what the investor thinks. And number two, do I trust this guy enough to give him my money? That's the two things. Okay, that's the two things. In the investor's mind, that's the two things that in the investor's mind. They don't think about how beautiful your numbers are, because you can give them beautiful numbers. If in their mind doesn't make sense, they will not invest. That is why very powerful and very knowledgeable investors can tell you when you are bullshitting. You understand? When you are coming up with nonsense, they will tell you, because they understand the environment. They know when you come to them with, oh, I did this, blah, 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 blah. And then they listen to your numbers, and they look at the market, and they look at the competition. They say, nah, you are not, you're lying. Something is fishy. And 70% of all the deals made on this, even on the startup competition platforms that you see on television, like your Dragon's Den and Sharks and stuff like that, you will find that 70% of those deals never went through after due diligence. Okay, never went through. They never got the money. You understand? You will say, "Oh no, they closed the deal and everything," but when they went for due diligence, they have not closed the deal. They have not got the money. So these are the things that they look into. Credibility is crazy. It's very important. And you will find investors are very, very, very crucial with that. So your company cannot show ability to scale if you don't have these two things. You have to convince your investors to see that, that your company is scalable. Number one, your margins on your pricing, or how much people pay to get your product. That's number one. Number two, it's you as the entrepreneur. How committed are you on this business? And both of these must always go together. Never one and the other one out. Never get one and the other one out. It always must be together. Investors can give you money, and maybe they can like you, but because your business doesn't make sense in terms of numbers, they're not going to invest. And also, investors can be happy to see that your numbers are very good and interesting. But if they don't like you, if they don't see trust and commitment in you, they're not going to invest, right? So both things work together. Their ability to see that they can make money out of this, that their money will come back, and number two, how much they trust you to give you their money. I think that is it. That's what I can say on this point.
I think one last thing before you go. There's something that we said at the beginning. It's called unit. You said unit economics, and you said something about startups and costs. Maybe you can demystify these things for people. What exactly unit economic means for startups, the difference exactly for startups, and the difference for stocks, companies that have stocks, much more established companies. That's the last.
So what does unit economic means?
Yes.
Okay.
Yeah.
Unit economics basically is it's like it's a tool. It's a very deep way to look into investing and business analysis. It's basically a tool, or having a view, right? It's a way to answer. It's a way to answer questions that are very critical, and in terms of business ability to grow, right?
Yeah.
Let me put it this way. You as an entrepreneur or as an investor, for example, okay, and just without having to go into like a lot of details, right?
Yeah.
It can be, let me put it, four things. Number one is on the unit can be customers. It can be maybe one customer, right? At a point, unity of economics can also be one product, and also unity of economic can also be a way of looking into one transaction. Can be in a marketplace or fintech, for example. And also it can be looking, if you're in a real estate, for example, you say it's one property, right?
Yeah.
Unity on economics is like you look into one thing specifically that then is the major driver of your profit in a company. Okay, so now on this aspect, it's like you looking into all the items that you sell You're looking at all the product that you sell, and then you want to look into the perspective of the revenue and growth of your company as an investor. You instead of looking at the overall perspective of the growth of the company, what you look into two things. You look into the revenue per unit in relation to the cost per unit. Okay, you try to bridge that gap of understanding between how much you make per unit and how much you spend per unit. Example, how much do you make for one Coca-Cola, one bottle of Coca-Cola, fully branded to get to the market? And how much do you spend to actually get that one bottle of Coca-Cola fully branded before getting to the market? Okay, so each unit must be profitable. So you're looking at things from a singular, one lens, not in a broader lens, one lens.
Not like one.
Yes, not on how much I'm making after selling 20 bottles. No, it's how much you make by selling one.
Oh, it's the same way you said even about the customers. You're looking at that one customer. How much
one customer
is he?
Yes. Yes, that's always coming and always coming. You analyze that person, his character, his attitude, how he buys, why does he buy that? You know, that's why I'm saying that unity of economy, it's like it's a tool, it's a way of looking at the economy or the business on its own, but from a very singular perspective, instead of stereotyping that everything that we make, it's the same. Don't stereotype it. Bring it to one singular thing, and then you say, this one customer, this is how much buy, this is what they do, this is how things works with them, this is why they normally buy this product, and this is my product. Okay, I have 10,000 of this product, but this is the product that makes more money. What makes it sell more? Why should I sell more of this? Yeah, because even when it comes to break even, sometimes you also need to understand one thing. You need to look into which products is the best seller, or which product should you sell more in order for you to break even. Okay, that's also another perspective of in the break even side, and that's the same idea with the unity economics. It's like you have to be able to see in the loop of all that you sell, of all products and services that you provide and you sell, which one of them should I put more effort into in order for me to maximize profit? Or if you're looking to break even, which one of the products or which ones of the products should I push more in order for me to break even? Okay, so those are the lines of thought when it comes to unit economics. But there's many more technicalities around that. I mean, it's not just, you know, not just the idea of analyzing one perspective of things, but also you have what we call, like, it also goes down to what we understand as understanding customer metrics. You know, how most customer acquisition process works, what you do in order to get your customer, you know, the process that you take, how much it costs you to get that one customer. Okay, that's what unity economics means. That's why I say you look into specific aspects of your business, very, very, very specific, right? And the second is always the lifetime value, which is the total revenue or profit from a customer over time. And that's, you look into one aspect. And I will repeat it: if the investor wants to understand your ability to scale, he also sometimes looks into those aspects. But it is up to you as the entrepreneur to understand that as an entrepreneur, you must have a clear understanding from a unit perspective, what it costs you to get one customer.
When you say from a unit perspective, it means what it costs to make one product, what it costs to get one customer, what it costs to price one stock.
Yes.
Yeah. Oh.
Yes.
Okay. Does that usually affect also the scalability of a business if you don't actually look at the unit economics of your products or your customers? Does it affect very big on?
Yes. And you know what? This should be the first thing entrepreneurs should be focused on when they're starting a company, especially for those who are in the product selling space. Because I mean, how are you going to raise funds from an investor and you don't even understand how much it costs you to get one customer? You want to raise funds, yes, but you don't even know how much it costs you to get one of your products, just one product sorted to the market.
Yeah.
You don't know. You don't have a clue. You just know that the supplier charged you $5 to get the product sorted and done, but you don't even know how, like the process from packaging, bottling, branding, marketing, and getting into the customer, to your first customer. You don't know. You understand? So
yeah.
I remember there was this young lady I was helping before. I was training for bookkeeping, and one of the exercises that I gave her was to build a bookkeeping sheet, like for the financial statements for a food business, like the food that they sell on the streets, like the tuck shop where they sell food, something like that. So it was selling like samosas and hot dogs and stuff like that. So that's what the idea of the project. I gave her that project with the idea to help her understand that you can start anything if you actually understand how much it costs you to start it.
Yeah.
Because the only mindset that we have today as young people, and I'm giving that example, I know I'm giving this advice, I know many young people will follow this. We are stuck in the mindset of saying that we don't have money, that's why we cannot start a business. But if you ask that same person, what idea do you have? I want to do this 1, 2, 3, 4. Do you know how much it will cost you for you to start it? They will tell you they don't.
Yeah.
But end of the day, they are telling you that they don't have money, that's why they cannot start the company. But they do not even understand. They don't even know how much it will cost them to start it. So now, how would you raise funds without understanding how much it costs you to get one product done or one of your services out? You don't have an understanding around that. But we are stuck on the mindset of, look, I don't have money, that's why I can't start my business. No, man, it doesn't work like that. So understanding this aspect of your business, which normally we call it management accounting, it's very important, because this part of the business is management accounting. Studying one customer. When that customer comes regularly, you understand exactly from the process of acquiring this customer to the process of making that customer a loyal customer in your company. That life cycle, that whole process, you as the company owner, as the entrepreneur, you must have a very clear understanding of that process, because that is what is going to be your reference to be able to get other customers. Okay, and that's what's going to be your reference to be able to know what is your target audience, what is your niche, what is your type of customer base.
I think I also just thought about it in terms of, like, let's say, like, social media perspective. What does it take for you to get that one viewer? Have you broken it down?
The same thing.
Statistic. Yeah. Okay.
It's the same thing. Okay. It's the same process. Okay. So once you understand that, it's easy. You will know. Like for example, you want to go to an investor, right? And the investor will ask you, what's your market?
Yeah.
And you're gonna give me a bunch of ideas and a bunch of numbers, a bunch of people. Like my target market are these people. you don't even have a clue of who exactly is your target market.
Yeah.
Okay. So understanding who is your target market, it comes by having a clear understanding of that one customer that you have acquired and that has been coming to buy your product. If you study that one customer, you know why this customer bought the product and why this customer continues to come and buy the product. What motivates him? Okay, and how much it costs you to get that one customer. That's where you will understand that now, if you probably will be able to find another 100 customers who are exactly the same as him or as that customer. Okay, so that's where you develop your own niche. That's how you develop your own target market. Now, this is a basic thing, and when you use unit economics approach, you get down to that. And then when you use unit economic approach when it comes to production, that simply is to help you understand the life cycle of your product from producing it to getting it to the hand of the client or the customer. So how much it costs you, to get to, like, to find the supplier, then the supplier, how much it costed you to get the product start, the product actually they're making it, to produce the product, and then whatever got inside there, what are those things that got inside the product to make the actual product, and then how much it costed you for that process to happen, including packaging, including branding, including marketing, including all other things in the middle, you put that on there, right? And then you exactly know clearly how much the product, to get one product, how much it costs you. So now, the benefit of this is that when you know how much it costs you to make that one product, you will be able to price it properly so that you can be able to make money. Are we together? So now, that is where also the unity economics comes in, because once you understand that part of the business, you will be able to have a different view in terms of pricing, margin, environmental issues, what can affect your pricing, what cannot affect your pricing, and how much profit you can make out of that one product.
Yeah.
You get what I'm saying? So it's a very simple concept. It's just people, sometimes the terms sometimes can complicate people. But
actually that's what, like, I wanted this episode to actually demystify, especially that part for the unit economics. If I actually type unit economics, like, now you can understand why, like, the finance jargon is usually very, it's usually very complicated, such that people usually just shy away from it, either part-time or even completely. So you find that now, from there, if you can actually break down those barriers from one step to the other, it'll be actually be very, very helpful to a lot of people. But thank you so much. I think, guys, we have taken too much of Lusimadio's time. Lusimadio is a very busy, very, very busy young man. He's a very, very, like, as you can see, he's part of you can see over here. Visit over here. You can see this thing over here. It's the Africa Youth Advisory Council. He's also part of it. Thank you so much, Lusimadio, for your time. We're always very grateful for you to come here. I think this episode specifically will help a lot, especially to the young business people and the young entrepreneurs, and also the young investors who want to come and be investors. Thank you so much for your time, guys. We're waiting for your questions to Lusimadio. In case you have any questions, please don't what's it called? Don't feel bad. Don't feel shy to actually ask him questions. He's always free, and you can catch his book on Amazon. I'm going to also post a link. I'm going to post a picture of his book on Amazon. Please, you can tell them again about your book, Entrepreneurship.
There's one more thing I want to mention so that we can close.
Okay.
It's a closing part of this.
Okay.
So I want people to remember this. Out of all that we've said here, when you're building a company and you want an investor to be attracted to it and to be able to see it as a scalable business, remember this: your lifetime value, right, must always be must be at least 3 times more than your customer acquisition cost. Okay, so your lifetime value, the lifetime value of a customer, of your business, of your customer, of your service or product, it has to be 3 times more, at least, than your customer acquisition cost. So, in other words, I'll break it down. If your lifetime value is below your customer acquisition cost, then you are not making money, you are losing money, you are broke, you are dead. Okay? Number 2, if your lifetime value and your customer acquisition cost is equal, simply means you are on a break-even point. That is why I mentioned in the beginning, your profit must be equal to your expenses, in a very simple language.
Yeah.
Okay? But now, if your lifetime value of your product, of your service, of your customer, of everything that you're doing, of your company, is 3 times, is at least 3 times or higher than your customer acquisition cost, then you are making money. And then that simply gives the investors the idea that your business is scalable.
Yeah.
Okay? So that's why in the beginning I said, any business idea, any project can be scalable. You just have to understand it. Right? And this is the structure that I'm giving you guys now as a last words to end, as you would like to end the call. So, yeah, that is it.
Thank you so much, Lusimadio. Thank you so much for your time. Guys, as you heard it, 3:1. Lifetime value, lifetime customer value and customer acquisition. Lifetime, was it lifetime acquisition value? Lifetime
Value of your customer. It can be of your customer, it can be of your product, it can be of your company. Yeah, it can be of anything, of whatever you are trying to study.
You heard it. It has to be 3:1. And from there, we ended. Thank you so much, Lusimadio, for your time. And we hope to see you for the next episode. Guys, the next episode is coming out. Thank you so much, Lusimadio, for your time. And yeah, we'll see you again. Thank you so much. All right.
Thank you.